You might have heard the old investing advice, time in the market beats timing the market, but what if you can have both? Well, good news, we are right now in the middle of what is likely one of the best buying opportunities for stocks, for crypto, for Bitcoin, even for real estate, right? Could we get better deals than right now in 2023? Absolutely. Still lots of potential for insanity in the macro scene in particular. But prices are getting pretty juicy, and it's interesting to be dollar cost averaging in during this time. And I know that you probably want to wait until everything gets back to its all-time high to buy. That's what most people do, but I don't. I like buying when it's cheap. So what makes 2023 such a great buying opportunity? Well, the market isn't as unpredictable as you might actually think, and you don't actually need to focus on timing the exact bottom, right? Some people are waiting just like, I'm just gonna get only the exact bottom, it's the only time I'm gonna buy. Right now, we're in the middle of a bottoming process, potentially for the markets, and almost every asset class is down right now dramatically from their all-time highs. Stocks are down, tech stocks are really down, Bitcoin's down, altcoin's down, real estate's down, watches are down, cars are down. Fire sale isn't over yet either. So it is worth taking some time to try to understand what is actually going on in the markets here and to learn where they're heading. This means that we as investors can respond accordingly and, of course, try to make smarter investing decisions based on the information. You see, right now, central banks are being rather predictable in what they're doing. Central banks have the tools that they can use to try to control the economy and to control financial markets through monetary and fiscal policy. These banks tend to overstimulate an economy in a bull market, and on the way down, they tend to over-tighten an economy in a bear market. Now, this is usually due to an over-reliance on rock bottom interest rates, and of course quantitative easing. Sound familiar? This is all the stuff that's been going on for the past few years. With over a decade of quantitative easing, and it's basically a 2-year blow-off pandemic top from all the stimulus, the markets needed a bit of a reset. We are in the middle of that reset right now. There's an obvious correlation that we are seeing here between both increasing interest rates as well as taking money out of the supply and the falling prices of assets that have been going on for about the last year. Now, using this time to build your investment portfolio could end up being a pretty smart move if you fast forward 2, 3, 4, 5, 6 years. And with every reset, central banks tend to over-tighten by increasing interest rates too hard, too fast, because all they have is a hammer and all they can see is nails, right? And that can end up leading to recessions. Now, we're still doing the recession dance. Are we in a recession? Are we not in a recession? Is a recession coming? When's the recession coming? How bad is it gonna be? Is it gonna be shallow? Is it gonna be the worst one ever in the history of humanity? Soft landing, maybe. We don't know. We don't know how much more pain is yet to come for markets. We do know there will come a time, though, when the Federal Reserve says that enough is enough and they're going to have to change course, that a pivot is going to happen. So what are the stages of a Federal Reserve pivot so we can watch out for this when it happens? Well, there are 3 stages of a Fed pivot. Stage 1 of a Fed pivot is to slow down the pace of the interest rate increases. This means that more rate hikes are going to come, but smaller increases happen each time. Remember, this has been the fastest cycle of interest rate hikes in 30 freaking years. We saw the Federal Reserve begin to slow down the rate hikes back in December of 2022. Then the Fed chose to hike 0.5% rather than the previous 0.75%. Then again, this week we saw the Federal Reserve slowing those interest rate hikes once again, only raising by 0.25%, meaning that we are getting closer to a terminal rate. The rate hikes are slowing down. The faster they slow the rate hikes, the faster they end up moving on to stage 2. We can hopefully expect to see the last rate hikes around March or April of this year. If that's what happens, markets are going to like that. But we need to see inflation continuing to trend down for that to happen. But for now, stage 1 has definitely been initiated. Then we move on to stage 2 of a Fed pivot, which is the pause in interest rate hikes. This means no more rate hikes in the current money cycle. Interest rates will remain at peak levels until further notice, and they could remain high for a while. This is the thing, they might get up to 5 or 5.2% and remain there for 6 months or a year. Markets can rally though during that time, as there gives you a certain degree of stability to the markets. We must remember that interest rate hikes can take around 6 months to really filter down into the economy, which is why the Fed is likely to overdo it. They tighten too hard to ensure that what they want to happen is going to happen and have it happen fast. That leads us up to the third and final stage of the Fed pivot. That is, of course, when they start to cut interest rates. Now, the Fed has said that they're committed to bringing down inflation, or at least need conviction that it is fully on the road back down to their target, which Probably 2%, although they've said, well, maybe 3% inflation. Maybe that's the new target. Probably 2%. So we can expect rate cuts at this point or when something within the bond market breaks. Either one. A cut in interest rates will signal to the market that enough damage has been done, and make no mistake, they are intending to do damage, and damage is what they have done. Historically, the Fed has cut 350 basis points within 18 months of the start of a recession. Currently, the bond market is pricing in 200 basis points worth of cuts from June. Pretty interesting, right? Now, this would put the bond market's base case at a 60% chance of a recession coming. Another key thing that we are looking for during this particular time is for the central bank to change their sentiment, right? We can expect a change from being hawkish or conservative to dovish or more liberal in their policies. Hawkish is the word that we use to describe when a central bank basically has a priority to slow down the economy. This is bearish for markets. And dovish, that's the word that we use to describe a central bank whose priority is to get an economy growing again. That is a bullish signal for the markets. So it's during this entire bottoming process when rates are being raised up that you're likely to find great investment opportunities. The kind of opportunities that you're probably gonna look back on in 5 years' time and go, ha ha ha, yeah, that was a smart move. Hopefully. Anyway, that's the idea, right? That they had the courage to invest when no one else wanted to. Now, before telling you about how you can make the most of this opportunity, I just want to let you know about my weekly cryptocurrency investor newsletter. It's called Wealth Mastery, and it's just jam-packed full of alpha. We have alpha on altcoins and airdrops and testnets and NFTs and step-by-step DeFi tutorials showing you how to earn great yields in crypto, market analysis, and much more. Join our over 50,000 weekly readers by signing up for free using that link down below in the description. So how can you make the most of this opportunity that we're seeing right now in the markets? First, of course, you need to understand that bear markets do not last forever. They just don't. Even the worst ones, they don't last forever. So it's important to take action and to make the most of it while it does actually last. So you can start to do that by making a plan. If you're not already dollar cost averaging into the markets on a regular basis, then this is actually maybe one of the first things you like to consider doing. Something I've been doing. I've been dollar cost averaging to my favorite stocks and to Bitcoin, right? You can set up those regular payments into your investment account and just invest in the top stuff, the blue chips, right? They may not have the biggest gains, but they're gonna have solid gains in a future bull market. That's your Bitcoin, that's your Ethereum, that's your S&P 500, maybe individual stocks like Apple and Microsoft, whatever, right? The blue chip stuff. They're large, they're profitable companies, or they're big brand name cryptocurrencies, things that are big enough, robust enough, and profitable enough to survive really any kind of market uncertainty that we may face in the future, and will probably provide decent returns in the long run. As well as that blue chip you might want to get into your pocket, you might want to look at averaging into growth opportunities as well, things that you think are going to do well in the next bull market. Maybe allocate a smaller percentage of your portfolio to those riskier plays, but that could be hot tech stocks, new altcoins. You've seen huge gains already in some of this stuff. We've discussed these money-making alternative narratives here, as well as in the newsletter. But of course, you have to plan for the worst and make sure that you have enough cash to be able to last out a prolonged bear market. It's a bit of a balancing act. You want to be invested, but you also want to make sure you're not completely invested and have cash in case things go way worse than you think they are, right? The next step here as well could be to try and increase your income during this time. Make sure that you're looking for ways to earn as much as possible so you can invest as much as possible. And of course, spend as little as possible during 2023. So if we're talking about just investing more, well, here's a few ideas that maybe get a few more bucks into your pocket, and then you can get a few more bucks into the market. Negotiate a pay rise with your boss. Just ask for one. You never know what'll happen. Maybe they'll give it to you, right? And remember, if your pay rate increase is less than the annual inflation rate, then you're actually getting a pay cut. Take on some extra hours too if you have the capacity to do that, obviously. Maybe even start a low-cost side hustle in your free time to try and top up your salary. I mean, the opportunities online for a side hustle are like ridiculous. So much money to be made online. Take up odd jobs in your local community as well. Set a timeline, get creative, think on your feet, see what you can pull together. Chances are there's a lot of ways that you can increase your opportunities to earn money now, to invest during this bear market, to have a better life later. And once you do start making more money, don't let lifestyle creep into your life, right? If your income increases, try not to let your expenses go up too. Remember, you're making extra money in order to invest it to have a better future. You want your expenses to remain the same or even go down slightly, and then take that extra cash and put it into investments. Also, pay attention to the markets. This is the year when you want to be dialed in to what the heck is happening in stock markets, crypto markets, real estate markets, all that stuff, right? We're seeing the data from the Fed coming in. We're seeing what they're basing their conclusions on. That's inflation. What's happening to inflation? Very important. What's happening to the interest rate? rates, with GDP, the labor markets, right? This is all factoring into what's going to happen economically, right? Whether we're having a recession or not and all that stuff. The stock market could continue to fall throughout this tightening cycle, so you have to be very careful of that, even though it's looking very bullish right now. So keep an eye on what is happening, and any sort of negative news stories can move things real fast in the same way that positive news stories have been. Also keep in mind the stock market doesn't typically bottom before a recession begins. So if we do get a recession, that is something very much to keep in mind. And remember that if we are in that recession situation, that when the interest rate cuts do come during the recession, that is when we're likely to see some real shakeout happen. Don't be afraid to stay invested during this time. Don't be afraid to be dollar cost averaging during this time. Chances are, if you zoom out a few years, this will have been a fantastic time to be dollar cost averaging into some of your favorite assets. Okay, that's it. Subscribe now. See you next time.